Good afternoon. This is Dan Kerr's DK Analytics. It is April 11th, 2019. I'd like to present the following topic in video format. Anyone got a valuation reset match? Question mark. Before I do, briefly some valuation metrics. The U.S. trade-weighted dollar hanging tough, hanging high at 92.32, despite increasingly copious evidence that the Fed is going to pursue U.S. dollar value destruction. The U.S. 10-year Treasury has been under some pressure. The yield up near 2.5% intraday today, April 11th, 2019. The S&P 500 vaulting back to all-time highs or near all-time highs at 28.92 intraday. Oil continuing to gather steam, up very stoutly for the whole year, and good 40–50% higher than a year ago at $64 nearly. Gold flirting with the $1,300 level, not really reflecting the Fed confessions of currency debasement going forwards, a permanent feature, or if you will, monetization. And its little brother silver also going nowhere at just a bit over $15 per troy ounce. Let me focus on the topic at hand, valuation. All right, valuations and what I think is a reset, looking for a match. The U.S. stock market, as you're all very aware, has recovered all of its lost ground and then some. That nearly 20% correction in the late months of the last 2 months of 2018, that nearly 20% Standard & Poor's 500 correction has been washed away. And we're reaching, once again, for all-time highs. What happened? Well, the Fed got cold feet in the near stock market meltdown that was gathering force in the last 2 months of Q4 18. And suddenly, surprise, surprise, sustained interest rate increases and sustained balance sheet expansion at $600 billion per annum were off the table, taken off of autopilot, as Powell referred to the balance sheet shrinkage, also known as QT. They were paused, and in terms of the QT, an end date is seen towards the fall of this year in the third or fourth quarter, early in the fourth quarter, and interest rates are not going to be raised, and the Fed opened up Pandora's box to permanent monetization or currency debasement, with QE being part of its future toolkit as and if necessary. In the interim, the IPO market is foaming, or has been foaming. No mystery there, given how strongly the stock market has rallied with the Fed promising a lot more financial cocaine. For example, Lyft, Uber's competitor, was recently brought public with a $22 billion market cap, despite generating nothing other than an ocean of bottom line red ink since its inception. Now that stock has been under some pressure, 15–20% below the IPO price, I think 18% yesterday, and Uber, sensing maybe the froth was going to subside, is also positioning itself for an IPO so that the billionaires invested in it can actually sell stocks, which they can't if they're privately held or only with great difficulty. But what's the takeaway here? It used to be in years and decades prior that companies stayed private until they showed they could translate top line growth into bottom line profits, into black ink instead of red ink. But in the day and age of Amazon, which for decades lost money, despite top line growth, in the day and age of financial repression, companies don't worry about losses, even gaping losses, or not so much. I guess the term better read than dead has new applicability. In the interim, in the nation's capital, Trump and on roadshows, Trump continues to tout the best economy ever. Yet, his current erstwhile cocaine-sniffing economic advisor / cheerleader, Larry Kudlow, who never saw unfunded tax cuts and asset bubbles he didn't get all excited about, let it be known that the Fed shouldn't just stop raising rates, but it should revisit zero interest rates, or ZIRP, and that in one fell swoop. Meanwhile, the president, not to be outdone, came out last Friday and doubled down on snorting Larry's statement by telling the world that the Fed, which he so criticized as a candidate, and rightly so, excuse me, for its bubble engendering manipulations, should now revisit money printing by launching QE4, as in right now. Clearly, this jawboning is political. Monetary policy has a 1 to 2 year lag. That's why those interest rate increases from 0 to a pathetic 2, 2.25 are only now starting to show their impact. And that impact is worsened by the incredibly over-indebted state of the economy. So it extracts a steeper toll. Well, I guess it's better to beat the Fed over the head as done by Trump or his administration, with a club now as an insurance policy for the 2020 election. Plus, if the Fed refuses to reverse its formerly restrictive interest rate and balance sheet stances, I mean, we still got a very accommodative policy, right? With 2.25% interest rates and nearly a $4 trillion balance sheet of the Fed. This isn't exactly tough love for Paul Volcker variety, or even a tenth of that, right? But if the Fed, states Trump, refuses to reverse its current interest rate and balance sheet stances, QT stance, then it could ruin or fail to save the best economy ever from hitting a brick wall. Now I ask you, which robustly growing economy would hit a brick wall with 2.25% interest rates, again, nearly a $4 trillion balance sheet? None. So this is a lot of malarkey. In any event, if the Fed doesn't loosen an already accommodative stance, Trump can blame the Fed if the economy blows up prior to the 2020 election, which it's highly likely to do any day now, as we've discussed before, given the inheritance which it is carrying. Anyone got a dollar incineration match? Speaking of blowing up, we once again have a chasm the size of the Grand Canyon between a monetary heroin addicted stock market and economic reality, be it at the macro level or at the micro level, where headwinds to EPS growth, much less EPS nosebleed level sustainability, are gathering like a heavy summer storm. This is even more likely, this upcoming storm, in terms of performance numbers, EPS numbers, heading way south. It's even more likely given the cycling or anniversary of last year's politically bloated EPS tallies on the heels of deficit-widening corporate tax cuts and even more aggressive stock buybacks at even more insane valuation levels on the heels of repatriation of overseas profits at lower tax rates. Not much organic growth there is the takeaway. More financial engineering and more debt. The impact of this when the tide turns will be stark. At the macro level, various disappointing economic statistics point to increasingly tough sailing ahead. Items such as bloated inventories, for example, the inventory to sales count is just ratcheted way up, happened mostly last year thanks to firms wanting to beat the tariff, intermediate and raw materials cost inflation, tariff-based intermediate goods and resource cost inflation. It's also items such as and by the way, that bloated inventory level suggests that if end demand is weaker, which is what I'm going to point to, that they need to thin the balance sheet, sell what they've made and make less, which obviously has a negative impact on the economy, on economic growth. But a rising inflation rate on the back of sustained service sector inflation and sharply rising oil prices, record auto loans and student debt loans, both trillion-dollar ugly giants, record corporate debt, record amounts of junk bond debt, lackluster productivity growth, and huge growth in federal government deficits, as well as the trade deficit. We've got 1.3 to 1.4 trillion heading sharply north, federal government deficits, and the trade-only deficit arcing in the direction of $1 trillion a year. You're looking at between 2 and 2.5 trillion here of financing at the end of the day that needs to be found, yet we know where interest rates are. Nowhere. Well, what this all really suggests in a nutshell is it's an accident waiting to happen. It's an air pocket that could pop. Or an air pocket that can't hold the airplane up, excuse me. As regards the just ended quarter, retail sales, production output, new orders, freight activity, home sales, construction, and the trade deficit, which were in aggregate weak, should continue to constrain GDP growth in QT. Throw in inventory liquidation to that, very important. And we could see back-to-back weak GDP, real GDP growth quarters, in fact, very weak. And this is juxtaposed against a muscular stock market in the US. Let's look at specifically the multi-trillion-dollar debt explosion for a moment. And first, let's have a gander at the investment grade kind from a different, that is more encompassing, telling angle, which ties together both Europe and the US. And these data points, this chart is courtesy of Fitch, Bloomberg, and a website, a hyperactive website by the name of Wolf Street, named after its founder or the guy that puts out unbelievably frequent and detailed content, Wolf Richter, a gentleman of German extraction. But let me show this to you here. What we've got, let me get this centered, is US and EU investment grade bonds, right? We've got triple B, the lower rung, the lowest rung of investment grade, that is that grandmothers can buy and pension funds can buy, has more than tripled since 07. He's starting with 07. I'm going to use that as a base year for the other comparisons here to be consistent. But we've had a tripling to 3 trillion in the US and in Europe. A+ corporate debt is up 2.5 times to 2.1 trillion. Total US and EU corporate debt has more than tripled in the last 11 years to a whopping 5.1 trillion. And that's non-financial, non-bank debt. Now, juxtapose, if you would, this corporate debt explosion in the EU and the US against 22 times trailing 12-month gap Standard & Poor's 500 earnings per share. And remember that about 30% of S&P 500 profits come from Europe, right? And now take this debt explosion, take the 22 times trailing EPS multiple of the S&P, and the corporate bond complex could well implode, especially in a weakening recessionary environment. In the US, we've actually got $3 trillion in increased total US corporate debt since the last quarter of 2007, up to a mind-bending $6.2 trillion level, a doubling or more in 11 years. Couple these facts with a 10-year emphasis on financial engineering-based stock buybacks versus organic growth, and we could have corporate bonds in deep trouble, deep solvency trouble, given the increasingly leveraged balance sheets. Do you think last-in-line stockholders aren't even more exposed than their bond, than their creditor brethren in terms of losing their invested capital, be it either in outright bankruptcy or massive dilution via secondary offerings at ridiculous stock prices? Well, last-in-line stockholders are the most exposed, and that's the point in terms of the vulnerability of an S&P 500 index and the stocks in it. Last-in-line shareholders get nothing if they go bankrupt. The liquidation, bondholders might get 5, 10, 15 cents on the dollar, whatever, better than nothing, but the stockholders get nothing. Moreover, if the balance sheet needs to be reversed, that is a bigger equity cushion, you know exactly when corporate management sells stock, when it's in the dumps. They buy it back when it's high and they sell it when it's in the dumps. So you add an insult to injury of a depressed earnings power added to a ballooning of share base of secondary issuance that will then really total the stockholder in terms of his exposure or loss of capital, however long that may be. And I'm going to suggest in this video that it might be a lot longer than in years past, and even there we have some frightening lessons in the 06 debacle to refer back to. For a broader preview of possibly widespread coming corporate bond and stock valuation attractions, consider what has happened to the erstwhile industrial and financial powerhouse General Electric, whose shares are down 76%, 76, from the closing days of 07, and whose bonds are on the verge of junk bond status. I grew up in Schenectady, New York. I know what happened after Reginald Jones with Neutron Jack Welch and M&A crazy Immelt and buyback crazy Immelt. They destroyed an icon. They moved away from organic brick-by-brick growth to sexier, more lucrative M&A deals, the stock buybacks. And this is what has resulted. What's scary about that is that GE is the poster boy not only of what went wrong with corporate America's balance sheet and with its lacking organic growth / product portfolio competitiveness focus, strategic focus. But this fallen angel, whose corporate anorexia was widely aped, also suggests that what's in store for too many shareholders and creditors alike across the corporate American landscape. When the explosive insolvency fumes that keep building and will be amplified in a recession that will spread from corporate bonds to junk bonds, or from investment grade to junk to consumer, and to states who are also insolvent due to their obligations vis-a-vis pensioners that they can never finance. But this is going to light a match. These increasing insolvency fumes are going to light a match, and it's going to be pretty sobering in terms of the revaluation downwards of a whole clutch of leading assets, from bonds to stocks to real estate. It's pretty sober. So how can anyone rationalize, I ask, a stock market trading at 22 times financially engineered peak earnings, GAAP EPS numbers, just bore a long overdue recession manifests itself? And it will happen. Recessions have been outlawed. We're carrying a lot more baggage than ever before, from misallocations to debt to reduced property right protections to reduced national solvency and sovereignty to transfer of citizen property to waves of third world immigrants, to lacking incentives to save. We've had yield deprivation. So how can we have a capital stock with which to invest in the future if the printing press no longer works because the currency is being repudiated? I'll get to that. We've got all these issues, and in a nutshell, the unparalleled misallocations, falling productivity, and debt that encircles the U.S. economy and much of the world's, from government to corporate to banks to the consumer. In the U.S. in total, over $72 trillion, which is up $3 trillion last year alone, to a level that equates 3.4 times U.S. GDP. With all these encumbrances, isn't a terrible outcome just a question of time, and time is growing shorter? That's my point. In fact, in the U.S., when we look at these debt edifices, if we strip out financial or bank debt, total U.S. debt at the end of 2018, without bank debt, financial debt, stood at $52 trillion, which is 2.5 times 2018 U.S. GDP, and up a whopping 2.5 trillion in just 1 year in 2018, non-financial total U.S. debt. A total, that 2.5 trillion, that exceeds 2018 U.S. nominal GDP growth of $1 trillion by 2.5 to 1. What will happen if interest rates are forced up by market forces? Like I said, does anyone have a valuation reset match? Earnings per share are set to compress substantially. A 50% haircut would give today's S&P 500 trailing 12-month GAAP EPS, that is the PE of 22 based on those earnings per share, a 44 PE very quickly at the current S&P 500 level. In other words, earnings per share fall in half. If the S&P 500 index stayed at the current level, we'd have a 44 PE. I've written on, and that is totally unsustainable. That's the point, right? In fact, it'll likely head the other way, and we're going to get into that, into PE compression, right? But I've written on this very topic quite extensively, most especially in post number 25 and 47. For details, I encourage you to go on the site and look those posts up. I've also stated this, mentioned this in videos such as cyclical and secular ROE pressures ahead earlier this year, and in the interest rate impact on S&P 500, as well as a potential energy disconnect, a video from, I believe, roughly a year ago. It's even more apt today, is my point. The upshot is the entire world is over indebted. We're talking about over 3 times GDP, 250 trillion plus, which is over 3 times global GDP. And the entire world is also misallocated, thanks to a decade of absolutely unparalleled global financial repression, be it ZERP, NERP, and QE. And I collectively, as you know, call this Frankenstein finance. Therefore, the upcoming Fed put, which has begun to manifest itself, will have to be mind-bendingly large to convince stock investors that there will be a relatively short EPS downdraft, which is impossible because, as we all know by now, money printing doesn't engender or promote organic growth. In fact, it destroys it because it takes the savings pool away from it and the incentive to invest in products instead of in stock buybacks, right? But that same policy does give us interest rate suppression-based asset bubbles, divorced, as you know, from fundamentals. That is, until faith is lost in a counterfeit currency being printed into oblivion, which is always a matter of when, not if. And that when is closer by the day. Plus, as we've said, we're facing a likely huge outsized EPS hit on the S&P 500 and by extension in most of the stock markets in the West, and I dare say around the world, although the developing world is already engulfed in this. There is little, and increasingly so, the European geography as well. But our point domestically in the US is that there is little earnings quality. There is no broad-based organic growth, just more debt, stock buybacks, magnify EPS. In other words, make the net income line look fatter, especially with the low interest rates they've been able to do it with, and misallocations. In other words, projects that were financed wouldn't have been if we had a real cost of capital, which means the outcome there is going to be abysmal. Throw in the redistributionism of governments and the massive deficits, and you add insult to injury. As a result of this, EPS, corporate EPS, obviously, may well plummet well in excess of the garden variety 40 to 50% and stay way down. Why? Because the fundamentals are so much worse today than even in the recession 10 years or so ago. Excuse me, I'm referring to debt, to misallocations, to the central balance sheets, central banks' balance sheets, to flatlining productivity, to evisceration of property right protections, and so on and so forth, to the lacking incentive to save, to provide the capital with which to invest strategically and grow organically in the first place. So this time around, we're not only in a much worse place than 10 years ago, we've just kicked the can and compounded our problems instead of learning from them. And 10 years ago, this is the takeaway, this is what's important, the S&P 500 EPS declined by a whopping 82% from top to bottom, and it took 5 years just to re-achieve the 2006 S&P 500 EPS, GAAP EPS watermark, high watermark level. This time around, when the stock market heads south, and it will, it may take unfathomable amounts of balance sheet expansion. And I'm not just talking about QT cessation, thinking about QE. I'm talking about printing untold amounts of money, buying assets, possibly handing them out to people, whatever the mechanism, it all ends in the same disastrous way. But we're going to need unfathomable amounts of balance sheet expansion by the Fed and other central banks to convince investors that the Fed will do anything and everything to bring back a stock market bubble, while that same Fed will likely have to step into the corporate bond arena, as we've discussed, and scoop up troubled bonds just like it did in the mortgage blow-up arena back in the crash of 08 and 09. Given that all debt levels at all sectors and in virtually all nations are much higher than before, both in absolute sense and relative to GDP, an increasingly debt-encumbered global economy, a zombie economy, reacts much less vibrantly to new central bank money creation or new debt taken on. This is shown clearly not only in Japan, the modern age poster boy of this sad state of affairs, but most recently last year in the US, where $2.5 trillion of non-financial debt only brought us $1 trillion of GDP growth. The downside implications of all that on bond and stock valuations, in my opinion, couldn't be more clearly negative, dangerous, value at risk, all right? As regards bubble valuation bonds, I would state that both unmatched solvency risks or insolvency issues and unmatched currency debasement risks grow ever larger and closer, that is, to actually hitting the market. This points to much higher future interest rates, higher insolvency and higher currency debasement risks. How else can you capitalize that in a net present value than through investors increasingly demanding much higher protection via much higher interest rates to offset at least a portion of the much more heightened or much heightened solvency risks, monetary inflation risks, currency debasement risks. As stocks, sometimes sooner, sometimes later, sometimes they lead, sometimes they don't, but over time they take their cue from bond valuations and the associated benchmark interest rates. With bond interest rates set sooner or later to go much higher to reflect the issues I just stated, share prices are set to get crushed, both from an EPS implosion perspective, number one, and from a strategic perspective. That is, it might happen tomorrow, in a year or two, I don't know, but from much higher discount rate perspective, which combined higher discount rates, lower earnings, will eventually result in a stock price drubbing double whammy. Yet the S&P 500 is at near all-time highs. The spread between 10-year treasuries and AAA corporates, the lowest investment grade rung, which has exploded in size, as you might gather, with all the stock buybacks and majoring in financial engineering instead of organic growth. But with just a 2.3% spread between 10-year treasuries and BBB corporates, this points to anything but a financial or economic crisis or tsunami around the corner. In fact, I'd argue it doesn't even point to a garden variety recession that's in the cards or close at hand. Instead, it paints the fairly calm sailing, a pretty blue sky or very blue sky scenario. Perhaps that calm sailing is interrupted with a moderate chop, but there is no tsunami in the wings, much less in sight. Speaking of recessions, I want to show you the second chart. Note that during the last recession, the 10 years, roughly 10, 11 years ago, the mentioned spread between 10-year treasuries and triple B, that is, triple B bonds, were 2.6%, currently higher than the 10-year yield, which is about 2.5%. But the spread in the last recession went from 1.5% over the treasury yield, the 10-year treasury, to 6% in about a year, before remaining elevated at roughly twice the spread it had prior to the recession. All right. Now, let me see if I can bring this on board. Here's the chart. Here's the chart. There it is. This is this vaulting in the last recession from 1.5% to 6%. All right. You notice what happens to yields of AAA corporates, and by extension all corporates, but as the lower down you go in investment grade towards junk, the bigger the pop. That is, the higher the yield goes and the lower the bond price goes. But what we see here is it then fell back down after all the assurances and global bailouts of banksters, and stayed at about twice the level it had before, right? Now, where does that leave us today? Imagine the following. This time around, aggravated by a likely even wider spread, given our worse indebtedness, lower productivity, misallocations, all that other terrible stuff, we're going to, which would result in a much weaker economy and one down for the count for longer, right? To correct all these imbalances that the free market would have corrected had it not been for government interference and cronyism, fascism ruling the roost. Instead of crony capitalism, if we had had free market capitalism, this would all have been cleaned up, right? But imagine this time around, if we have an even wider spread to the 10-year, then from 1.5% to 6% in triple B corporates. Imagine, and they call it BAA here, but it's the same thing as triple B. I just saw that from the chart. But imagine an even wider spread plus a dollar sell-off triggered by the Fed's permanent monetary debasement / monetization admission, otherwise known as QE4, which would also spike treasury yields, all right? In short, the worst of all worlds might be coming, or should be coming, I would dare say will be coming, to bond land. Rising treasury yields and fattening spreads. And in terms of that spread here, oops, sorry about that. In terms of that spread here of 6%, I would argue we haven't seen anything yet, maybe. As I continue to mention and repeat, I hope it doesn't grind away at you, the fact is that bonds and stocks are investment instruments that are valued based upon discount rate assumptions, upon the leading benchmark interest rate, with a premium. The worse the risk gets in stocks, typically, and shareholders, as mentioned, hold the bag when things go wrong. So they typically have to pay a premium on top of whatever the 10-year yield is, as do junk bonds, because they don't have the same protection as senior bonds. So junk bonds and stocks are tighter together than investment grade bonds, and stockholders are creditors of investment grade bonds that hold investment grade bonds, and stockholders are. What is the translation? Bonds and stocks travel together, that discounting mechanism that results in the net present value, the market value adjusted for debt, or the enterprise value. Both bond and stock valuations in turn, or again, net present values, are hugely determined by discount rates. Those leading benchmark interest rates, which are determined in today's world by a 10-year treasury, are looking as if they're about set to enter a bear market. The bonds are, with implications for interest rates heading way up, as I've just detailed. Staying on that same page, if you will, and to reiterate, does anyone honestly, when you step back, believe that today's absurd, I'd say perverted, insane bond bubble in the OECD, I mean, in Europe, Japan, there's what, $5 trillion again of negative nominal yield bonds, right? Despite this huge insolvency risk that we face across the board. We have these negative real world interest rates, even negative nominal interest rates. And they are the culmination, I would say, of a long in the tooth, 37-year-old bond bull market, global nature, that's just been pierced in emerging nations, but still is firmly intact and gathering force in the developed world, OECD nations, which is an opportunity, I would argue, an unsustainable valuation, in other words. But this 37-year-old global bond bull market has increasingly been enabled by, you guessed it, financial repression by the world's leading central banks by over 1 decade, for over 1 decade. But does anyone believe, in all honesty, that today's absurd bond valuations can be maintained, these negative yields, negative real yields, can be maintained indefinitely despite mounting solvency and monetary inflation risks? In a crack-up boom scenario, a little bit of Austrian school economics, in which a shift to real assets takes place, which will push up both the money multiplier and the velocity. And when you marry this to this unprecedented global central bank balance sheet expansion, you're going to get that slingshot effect in terms of a money supply just heading way up. As investors or economic participants are convinced that they're going to lose purchasing power if staying in paper assets, they will shift to real assets, and that very move will trigger a money multiplier revival. Marry that to the hugely expanded US and global monetary base, and you are in the classical monetary inflation manifestation, right? With that in mind, okay, I have to set this up. With that in mind, in other words, we're just at the beginning of what has to be, either through insolvency or trying to print us out of insolvency, monetary debasement, permanent monetization risk. One of the two, or both, are going to lead us into bond yields which make today's levels pale in comparison. In other words, much higher yields, much higher interest rates. And with that in mind, remember that stocks and bonds traveling together is thanks to the discounting mechanism, leading benchmark interest rates plus a risk premium. Once more, let me have you look, if you would, to sum this up, at this chart from Yardini and Co. By the way, the spread between the triple B and the 10-year Treasury was courtesy of the U.S. Fed. This here is courtesy of Yardini. And what this shows us here is that stocks and bonds travel together. How so? Bond yields and stock yields go up and down in pretty substantial synchronization. It makes sense, right? And a stock yield, the blue line is a PE flipped. When the stock yield hit 15%, in 81. That resulted in a PE, I'm sorry, it hit 14 in 81. It actually went to 15. That is the equivalent of a PE of 7.1. At 15 earnings yield, that is, you take earnings and divide it by the price. If you get 15%, that's a 6.7% bond yield. And I'm sorry, PE. And earnings yields go up with bond yields, all right? That's the message. I actually should have used the updated chart here. I apologize, but this is such a dramatic strategic window, valuation window, that I believe you can see what happens to earnings yields, bond yields, when we have a 37-year bull market. When this reverses for the reasons mentioned, we're going to go back to this. This is falling, sharply falling bond and stock prices thanks to higher yields, interest rate compensation that investors will demand given our mounting insolvency issues and monetary inflation risks. So I ask in closing my question, does anyone have a match? A reset asset revaluation match. It's not going to take much. This thing is going to feed on itself. It's like a domino effect, okay? Until then, whenever that is, it could be tomorrow, it could be a month, I don't know, it could be in a year, but it's coming. Sure as night follows day, it's coming. The laws of economics have not been rendered obsolete, and economics trumps politics. Count on it. You know it's true. Well, until that match is lit, there is a huge reallocation opportunity away from overvalued currencies led by the buck, overvalued bonds globally, well, that is in OECD nations, especially in the European and Japanese geographies, but also in the US, and overvalued stocks, especially in the United States. Arguably, the reallocation window is closing as that match is going to be lit, and those fumes are going to spread like wildfire throughout all assets and their valuations very quickly. So this is going to come to a close. That is, these bubbles are going to get popped very quickly. Bear markets are always faster than bull markets. Sometimes a 20 to 25% down gap in one day never gives the chance to get back out because a bear market rally will be 3-4% until the next shoe, and the shoe after that drops. And before you know it, you're a prisoner of a rapidly devaluing asset. That's the risk. So with the buck, with bonds and stocks, and by extension also much of the real estate, or ever less so because those bubbles are popping, but in the US that hasn't happened to a great degree yet in real estate, but it's coming and it's spreading. But we have these bubbly levels in these assets, the buck, bonds, real estate, and stocks, ever closer to popping. And that is, ladies and gentlemen, the increasingly fleeting reallocation opportunity. Said differently, get the hell out of overvalued currencies, bonds, and stocks, and also real estate. And set your funds aside in short-term investment grade. There really is no such thing, but you get my point. Government bonds. Purchase at the margin a stake in physical precious metals that you can touch, and then hang on because it's going to be a woolly and potentially lucrative revaluation ride. That, ladies and gentlemen, is all from here. Thank you very much. I hope you found something of interest to dial into your own portfolio allocation or reallocation thoughts. And remember, if you were one of the lucky or smart few that bought Nestle or 3M or whoever at a tiny fraction of today's price, you should hold those because you're not likely to get them back at that price. This applies for people that purchase stocks and bonds, but especially stocks because they have indefinite life expectancy until the corporation dies. those that purchased at very advantageous, very low prices and are currently having dividend yields of 10, 15, 20%, do not sell. But to everyone else, and unfortunately that's most of us, consider reducing your exposure if your purchase prices are in the overvalued category, which the recent decade or so current is definitely the case. Thanks a lot for listening.